Good morning, everybody. Good morning. We're going to get started. It's a great crowd, so thank you very much for everybody for coming out. On behalf of the association, Receivables Insurance Association of Canada, I welcome you. My name is Brad Hebert. I'm the chairman of the association and responsible for receivables insurance at AIG Canada. I think this will be an excellent opportunity for us as an association to say that this is our first event, but certainly not our last one. We hope to do this at least annually, and of course, you know, with more frequency if we can. We try to bring a good topic, and I think that this is definitely a good topic for everybody. We have some good speakers here. As far as the Receivables Insurance Association of Canada, we promote the business opportunity for receivables insurance, also known as trade credit insurance, to Canadian insurance brokers, the banking industry, and businesses engaged in both domestic and export trade. The association also works to advance industry innovation and product integrity, solve any business problems related to government legislation, and represent the interests of the members by facilitating an open exchange of information and ideas. What I would like to do, it's my pleasure to introduce our moderator for this morning's event. Robert Bob Dempsey was born in Stratford, Ontario, and he accumulated his formal education at the University of Western Ontario in a civil engineering degree. Bob joined the Guaranteed Company in North America in 1987 as branch manager, and in 2006 Bob was appointed president and chief operating officer of the company, working from their head office in Toronto. Bob has been a director of the Insurance Bureau of Canada and is presently the past president of the International Surety Association. Bob also is appointed to the Credit Insurance Advisory Group for the Department of Foreign Affairs and International Trade. Bob is a director at the Receivables Insurance Association of Canada and has been a member on both the governance and banking committees. Bob's advice, energy, and contribution to the association are invaluable. Welcome, Bob Dempsey.
Thank you. Thanks very much. You'll notice that the engineer gets a seat all by himself. It's because of our dynamic personality. We've got all of our panelists over here on my left-hand side. And I look outside and I see the weather, and I think, wow, this is really good of all of you to share some of your day today with us in comparison to what's outside. Weathermen are usually, we rely on them. We're not always trusting of them. And so what we've done this morning is bring three weathermen of the economy. Now we're going to rely on them. I don't know after their presentations whether we're going to trust them or not, but that's up to you to decide. So let's talk about the agenda a little bit. What we're going to do today is give each one of the gentlemen a presentation of about 12 minutes to give you their overview of the economy of North America, possibly Canada, and possibly the world. From that, we will then put the three of them together, and I'm going to refer to that session as the dueling economists. They're going to talk about each other's presentation and what's, no, I can't say that, sorry. What they believe in and what they agree upon, and possibly, and let's hope, what they don't agree on. And let's have a little chit-chat about it. Then I'm going to turn it open to you to come up with your questions, and I think all of this will take possibly an hour and a bit, depending on how energized you are with your questions. So let's start. First of all, what I'd ask you to do is to take your personality crutches and turn them off so that we don't get interrupted throughout the presentations. All right, is the economy going south or is it going north? And in order to answer that question, we brought a fellow by the name of North here. Dan North is the chief economist of Euler Hermes. Dan has been with them since 1996, and he's using macroeconomic and quantitative analysis to help Euler's risk portfolio of more than $150 billion in annual U.S. trade transactions. You're a busy man. As an economist, he's appeared on CNBC, Fox Business News, France 24, Bloomberg Radio and Television. He has been quoted by Barron's, Business Week, Paris Le Monde, Tokyo Nikkei, New York Times, and the Wall Street Journal. I'm surprised you haven't been the centerfold for some magazines. After having predicted the 2008 and 2009 recession and its implications accurately, he was ranked 4th on Bloomberg's list of 65 top economic forecasters in 2010. Congratulations. Who's 1, 2, and 3? No. Mr. North holds an MBA from the prestigious Wharton School of Business. Without any further ado, Dan, take us north.
Thank you, Bob. Thanks. Can everybody hear me okay? Okay. Well, I'm here to give the point of view about the recession, whether we're truly out of the woods or not, from the U.S. perspective. I'm going to speak for about 10 minutes, and then we'll move on. The question is, are we truly out of the recession? And the answer is, well, sure. Of course we are. If you're an economist, we're definitely out of the recession, because economists mean something different than what the rest of the world means when they say we're out of the recession's over. Most people, when they say the recession's over, mean that times are good, things are good. Economists do not mean things are good when they say the recession's over. What they mean is that things have simply stopped getting worse. The economy has stopped receding. It's not that things are good. Economists don't think things are good necessarily. It's just that they've stopped getting worse. Now, there's no debate really about that. The economy has stopped getting worse. The evidence is pretty overwhelming, but there's also no debate that things really aren't good. Times are tough for people. There's still a lot of people that are unemployed. We are not out of the woods, I wouldn't say. It's useful to look at the National Bureau of Economic Research definition of what a recession is. I have to turn and read it. Recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, wholesale retail sales. None of those things matter when you're out of a job. Who cares if you're out of a job what GDP is, if it's plus or minus 1%, or what industrial production is? Who cares if you're out of a job? The only thing that matters is employment. So to most people's way of thinking, the recession really isn't over. Now, the U.S. employment report comes out on the first Friday of every month at 8:30 in the morning, and it's by far the most carefully watched economic release in the world. And there's lots of numbers in this report, but these are the two that most people look at. The black line, which is the unemployment rate at 6.1%, and the yellow columns, which is the number of jobs gained or lost. And clearly we lost a tremendous amount of jobs in the Great Recession. But I want to compare our recession to other recessions to see, how it works out. So the way this chart works is each line is a particular recession. Each recession starts here. So for instance, that black line is the 1980 recession, starts here. And in that recession, we lost about 1 million jobs, but gained them all back. Came back to break even in something like, 12-ish months, something like a year. The orange line is the 1974 recession, where we lost about 3 million jobs and got them all back in about, 18 months, 20 months, something like that. The red line is the so-called jobless recession, where we lost 3 million jobs, and it did take 4 years, 48 months to get those back. You want to see our recession? That's our recession. A dramatically different picture. We lost 9 million jobs, and it's taken us 6 years to get back to break. 6 years. 6 years. It was just a couple months ago that we actually got back to break even. So I've run each of these curves out to where we got back even, break even for each recession. Now I'm going to run them out to 76 months to see where we should be compared to prior recessions. So here we are at 76 months, breaking even. Here are other recessions. Here's the '01 recession. After 76 months, we had 5 million more jobs. The '74 recession, after 76 months, we had more than 10 million more jobs. We should have 5 to 10 million more jobs than we do right now. No wonder the economy is so slow. No wonder people still feel like the recession is not over. Now, we look at other measures of employment, like we just saw this chart. That black line, the unemployment rate going down like that, that's a good thing, right? Well, not if it's for the wrong reason. You see, the way our government calculates the unemployment rate is this. If you don't have a job, but you're looking for one, you're unemployed. If you don't have a job, but you're not looking for one, you gave up, you're not counted as unemployed anymore. So if people stop looking for a job, there are fewer unemployed people. That's why the unemployment rate's going down. And this leads into our issues, 3 issues of structural unemployment, which are really impeding growth and still keeps us sort of in this recession feeling. If you're not looking for a job anymore, you're said to be not participating in the labor force. And that's this labor force participation rate, which you can see has plummeted since the beginning of the recession down to a level that's, we haven't seen since the bad old days of the late 70s. And why is the participation rate going down? Well, there are a couple issues. One is people give up because they can rely on the incentives that we have to give up. We have 25 states that pay more than a minimum wage in welfare benefits. We have 13 states that pay more than $15 an hour. We have 6 states that pay more than a starting computer programmer in welfare benefits. So these are huge disincentives to go to work. And we need a social safety net, but studies on the left, on the middle, on the right all say when benefits are this big, it's a disincentive to work. We also have this baby boomer issue, this demographic where 10,000 baby boomers are going to retire today, and they will keep doing that for years to come, and we can't replace them fast enough. So those are these structural issues that we can't get around. The second one is demonstrated by this chart. This chart shows the unemployment rate on the bottom axis, right? And it shows the job openings rate on the vertical axis. Now, each dot is a month in time, so it makes sense. So when you're over here, here's where you are in a recession. The unemployment rate's out there at 10%, and the job openings rate is very low. There are very few jobs to be had, right? And this is what a recovery you'd like to see. You do see, this is historical. In a recovery, the unemployment rate drops, and the job openings rate goes up. As unemployment drops, things are good. There are lots of jobs to be had. Well, that's what you normally see. Well, here's our Great Recession. Things kind of spun out to the right here. So the unemployment rate still stayed high, even though jobs became open. And right now, here's where we are right this minute. Job openings rate is really pretty high. Historically, if the job openings rate's that high, you should have an unemployment at 4.5%, not 6%. Why is this? How can there be jobs open but still high unemployment? Well, it's because employers are looking for these skills, and people looking to get employed have these skills. There's a skills mismatch there, and you hear this all the time from people with job opens. We can't find the people with the right skills. Part of that's due to training and education. I think we're starting to realize that the 4-year college education maybe isn't the right thing for everybody. In the States, in part of the States, you can make $150,000 a year as a welder now. So that vocational training is a big issue. And the third part, this is the skills mismatch, the third part of structural unemployment is how long people are unemployed, the average weeks in duration. So in the previous record was 21 weeks on average. That's how long people were unemployed in the '80 recession. Almost doubled in our recession and still at a remarkable 32 weeks. And the problem with people being unemployed that long is they become unemployable. So those are the 3 things that have the structural unemployment. Low participation rate, people can get out and stay out. Skills mismatch, and this duration of unemployment. And that's why we have 5 to 10 million people, 5 to 10 million jobs short. And that's why the economy is not being driven. 70% of GDP is personal consumption. The yellow columns here are personal consumption. And that horizontal line, that black horizontal line, is the average you'd like to see. You can see that consumption dried up during the recession and has never gotten back up to the average level. We don't have enough people at work. We don't have enough income. We don't have enough spending. We don't have enough consumption. The black line is the income you need to drive that consumption. So again, no wonder, it's growing so slowly. So let me conclude here. We may be technically out of the recession, but we're really not out of the woods. We're still 5 to 10 million jobs short from the low participation rate, the skills mismatch, and the duration. None of those problems are getting fixed by fiscal or monetary policy. Those two policies aren't addressing structural unemployment. And that's why income, consumption, and the whole economy is still growing way below par. We forecast 2.1% for this year, a little bit better next year. You'd like to see average 4.6% in a recovery. So the recession is technically over, but we're still not out of the woods yet at all. That's what I'm thinking from the US perspective, and I'll give it back to Bob from here.
Thank you very much, Dan. It's interesting. I'm not sure if we're headed north or we're just in the near north. Excellent presentation, lots of thought-provoking charts and graphs for some questions later on. Now, I would imagine all of you are now in your mind going, what's going to happen? Well, we brought a guy by the name of David Watt to answer that question. Corny humor, eh?
Yeah, that was pretty bad.
David Watt joined the HSBC Bank of Canada in May of 2012 as their chief economist, bringing about 20 years of past experience as an economist. A currency strategist, which I think all of us in Canada are now wondering about, the strategy of the Canadian dollar, and as a fixed income strategist in Canada's financial sector. David is responsible for the bank's Canadian economic forecast with a focus on bringing HSBC's strong global economic research to their clients. David started his career at the Bank of Canada with time spent at Canada Mortgage and Housing Corporation, plus other financial institutions. David holds a Master's of Economics from Queen's. That's too bad. Western has a better football team.
I went there too.
Where he also undertook advanced graduate studies. I give you David Watt.
All right. I actually did my undergraduate at Western, so I've gone to both. So. Thank you very much for coming this morning. Thank you for inviting me to do my presentation. I don't have any slides, but I will sort of say if you could go over Dan's presentation to scratch out United States and write in Canada, it's not really that much different. I would advise if there's any security around here, you might want to post them near the walls so in case people decide to test the strength of the windows. We are cautious on the U.S. economy. We're not even as cautious as Dan is. That was actually a very cautious view of the U.S. economy. It makes it easier for some of my story. Are we technically out of recession? Dan's gone through that. We are. We define a recession as 2 quarters of negative growth. We're not in a recession. Similar to the United States, in Canada, we've been doing somewhat better than the U.S. has coming out of this recession. But still, the Canadian economy has some elements to it that make me think that we're still not quite out of the woods, the title of this session. And the one that I like to look at, Dan went over in the U.S. some of the problems with the unemployment rate. Similar things, but not the same degree in Canada. I like to look at what's called the employment rate. So that's the employment to population ratio. And what you would tend to see is coming out of recessions, what you would tend to see is the employment rate would increase. So that means that we're creating jobs more quickly than the population is increasing. So in other words, you've got that labor demand, and we're basically not producing enough people to fill those positions, and so you get employment rate going up, and that's when you start getting consumers feeling better, wages going up, and the economy starts to go through what you would typically consider to be a normal recovery out of a recession. We started to get that coming out of the most recent recession in Canada. But the employment rate rose at a very shallow rate, which meant, yes, we were creating more jobs, or creating jobs at a quicker pace than the population was increasing, but not much. And then in mid-2012, things reversed. And all of a sudden, the population growth started to outstrip employment. So that told me that the Canadian economy just really wasn't creating what we would typically consider to be recovery-like pace of jobs. So we started to get the employment rate fading back down. Currently, the employment rate in Canada is equal to where it was coming out of the recession. So we're back to the lows. That tells me that something in Canada is just not working right. Now, the Canadian economy and the federal government touts this all the time. We've done much better than other G7 nations. That's right. It doesn't necessarily mean that we're doing well right now. When you start looking at what's driving Canadian economic growth, I also get concerned. What we've been watching for the past several years is waiting for the consumers to step back and exports and business investment to take off. This year at this time, every past year, we start looking ahead to the next year for our forecasts. What do we expect in the next year? Well, usually you get somewhat optimistic. You're also at this point in time looking back over your forecast for the prior year. And what we've done over the past several years is go, well, we were too optimistic last year, so the recovery is going to happen this year. And every year you get to this point and you go, the recovery hasn't happened yet. And so you push it out. It's basically been 5 years where we've been more optimistic about global economic growth, and then we have to revise down our forecasts. Well, eventually at some point in time you have to sit back and think, maybe we just have to get more cautious in general. Maybe the recovery that we typically associate just isn't going to occur. And so when we're looking out for the US economy, the Canadian economy, and the global economy, we're getting more cautious right now. Things that are reinforcing that view. We'll talk about the Federal Reserve raising interest rates next year. Our economic forecast isn't much different than Dan's. We think the Fed's going to be raising interest rates next year, not because they see this whiz-bang recovery in the United States, but just because they have to teach markets, and the Federal Reserve has to learn how to implement monetary policy again. Interest rates are near zero. Quantitative easing has lifted the size of the balance sheet of the Federal Reserve to an astronomical level. They don't know how to unwind themselves from that. They've never done it before. The US economy doesn't know, they don't know how the US economy is going to behave. They don't know how markets are going to behave. So even though the recovery is relatively lackluster, the Federal Reserve is going to have to start absorbing liquidity. But that's not happening in Japan. In Japan, the Bank of Japan is still aggressively quantitative easing. It's also not happening in Europe. Right now we have the ECB poised to start quantitative easing. That's one of the reasons why the US dollar is doing so well now and why the euro is getting slaughtered. We've got this divergence. The Fed's going to start tightening. The ECB is about to engage in quantitative easing. Japan is still doing quantitative easing and there's no end in sight. The ECB is about to start. When you start looking out to economic growth for next year, are you going to be optimistic or somewhat cautious? We are somewhat cautious. Now with regard to the Canadian perspective quickly. I'm concerned about the Canadian economy for particular reasons. One, the lackluster employment growth. But despite lackluster employment growth, consumers are carrying the economic growth than they have for the past few years. So how are they doing that? If you don't have employment growth, you don't have income growth, how are consumers continuing to spend? Well, we're doing it by running down our savings. The decline in savings in the second quarter was the largest in 15 quarters. The savings rate fell from 5% to 3.9% of disposable income. That cannot continue. You cannot continue to run down savings. What have we also seen? Well, Canadians have been borrowing. For a few years, we've had borrowing which has been slowing. That's a good sign. Suggests that Canadians, even though interest rates are low, realizing debt levels are high, we're going to get more cautious about borrowing. That restraint seems to be loosening now. And so we're starting to see borrowing trends starting to accelerate once again. So what we're seeing is we're increasing our borrowing and running down our savings amid lackluster employment growth and lackluster income growth. That's not a sign to me of a healthy economy. So I'm very concerned about consumers being able to carry the burden of growth. Now you look at exports. Not surprisingly, in the recession, given how damaging it was to global trade in general, we ended up having the largest decline in exports from peak to trough out of any recession. Then the rebound was also lackluster, not a surprise. We started from a deeper trough, so we were basically amongst one of the weakest recoveries of exports coming out of a recession in the post-war era. That was true up until about 2011. So what you would see is usually the exports go down as you hit the recession, and then I'll do it from our perspective. They go down, just pretend I've got a chart here. They go down, and then they begin to rebound. So we got that. We started to rebound. Then around mid-2011, our exports just flattened out, completely stalled. This was the time of the US debt limit debate and the impact that that had not just on the US economy, but on the Canadian economy. We've just recently now started to see exports rebound, but exports have rebounded sharply. Whenever I start seeing a large jump in a particular series, I'm not thinking that that's a trend. I think there are a number of idiosyncratic issues that are causing exports to rebound. When I look at what's going to be fundamentally driving Canadian exports, US recovery. We're lackluster in the US recovery, so I don't necessarily think that's going to allow us to catch up to past recoveries. When I think about what's going on with the US trade itself, I realize that compared to past recessions, Canada is no longer the largest source of imports to the United States. In the past, like in 2001, the jobless recovery, which was a sluggish one, at least at that point, Canada was by far the largest source of imports to the United States. Now it's China. So what we've basically seen is now that US recovery, which would have definitively pulled Canada along, Peter might have some disagreements with this, and so not all economists agree. We'll get into that discussion later. So as the US economy recovers, it's not going to have, from my view, the same pull that it had on the Canadian economy. So we don't really have the export story. Consumers are stepping back. Exports are going to be relatively lackluster. So what's going to drive Canadian growth? And that's where I start getting concerned. That we don't have that driver to get us to 2.5% to 3% growth in Canada. We're going to be 2 to 2.5%, and possibly even a little bit more sluggish than that if the US economy does go through a period of upheaval. So we've also got one other thing that we're looking for in Canada. What could fill some of the growth gap, and we've been waiting for this for 5 years, like everything else, is business investment in Canada. Business investment in Canada has so many crucial issues to it in order not just to drive in the Canadian economy short term, but also in the long term. From our perspective, the Canadian dollar is going to stay relatively strong compared to historical norms. We've got a competitiveness issue that's going to be lingering. To offset that, we need to accelerate business investment. We don't need the Canadian businesses to be cautious and waiting for business investment until they're definitively sure what's going to happen in the global economy and that things are getting better. We have to realize with trade barriers going down, the competitive pressures are going to be increasing dramatically in the next few years. Canadian businesses have to up their game, increase productivity, increase investment in business and investment. That's for the long-term perspective. In the short term, we need businesses to realize they've rarely been in better financial shape. Cash balances are extremely high. Debt-to-equity ratios are extremely low. The corporate sector is in extremely good financial shape. They can increase borrowing and increase spending on investment in machinery and equipment to increase productivity. Why that's also crucial. If we don't get that, what we're going to do is we're going to continue to rely on the Canadian consumer to carry the burden of growth. Households cannot continue to carry debt levels like they are. So what we basically need is this rebalancing. Households borrowing less, businesses borrowing more, and that shift from consumers towards businesses. We've been waiting for that for 5 years. We're still waiting for that. At some point in time, you have to think, maybe we actually, if we just sit back and wait for it, it's not going to happen. This is when you start getting into the idea, maybe we actually need governments to go out and tap the economy on the shoulder and start saying, look, households, you have to borrow less. Federal government has done that 4 times already in terms of telling the household sector effectively to borrow less in terms of action on the housing market. They probably need to do more given recent trends. We also need the federal government and provincial governments to start tapping businesses on the shoulder and start saying, look, we need you guys to start spending money. So we need that rebalancing, not only, and we can't just wait for it anymore, we actually have to start getting governments, unfortunately, starting to tell businesses and households, look, this has to happen because the stresses and strains that are going on in the economy, if they continue, it's not going to end well. And so with that optimistic note, I'm going to end my comments. Peter should be the optimist, so that's okay, so don't worry.
Well, I'll bet you all of you are on the edge of your seats wondering, how's this engineer going to introduce the next guy? Well, I guess we all wonder after those 2 presentations, are we in the basement of the economy, and are we ever going to get out? Well, if you get out of the basement, you got to walk down a hall. So we brought you Peter Hall. Not bad, eh? Peter, president of my fan club over there. Peter Hall joined the Export Development Canada, better known as EDC, in November of 2004. With over 25 years of experience in economic analysis and forecasting, Mr. Hall, is responsible for overseeing EDC's economic and political risk analysis, special research, and the corporate library. In addition to advising senior management at EDC, he's been a featured speaker at many conferences, international roundtables, policy fora, and regularly appears in radio, television, and I personally have heard Peter numerous times. He's a fantastic speaker, very clear, and certainly clairvoyant as to where he thinks Canada is going. He regularly appears, as I said, in television and radio with that. And he widely printed and video weekly commentary, if any of you would like to join in on his views for the future. Prior to joining EDC, Peter directed the economic forecasting activities of the Conference Board of Canada. He's the immediate past president of the Canadian Association for Business Economics, which is a 600-member National Association of Professional Economists. And he has degrees in economics from Carleton, that's too bad, and the University of Toronto, that's even worse. And we all know what the University of Toronto's football team's like. Anyway, I give you Peter Hall.
Well, I'm disappointed, Bob, because I thought you were going to say, well, after what you've just heard, you're now in for a hell of a good forecast. So maybe that's where we should have gone. I don't know. Yeah. Well, we'll trade notes afterwards. You know, Bob said, thanks everybody for coming in here today because, you know, the sunshine is outside and it's painful for you to have to sit inside here when it's so gorgeous out there. And if you get bored with what's going on up here, well, you got a great view. Well, I'm just about to bring some of the heat into the room here, if you're okay with that, and maybe a little bit of sunshine as well. Is that okay, Bob? Perfect. Can we do that? I think that in terms of setting this whole thing up, there are two words inside of the title that we need to address. And one is we. Who's we inside of all of this? And then what is the woods? Well, we all have different views of both of those things. We, as far as I'm concerned, is what is, or the entity that is actually getting us out of the woods. I think it's instructive in our world economy at the moment to know what's driving things and what's actually lagging behind. And then the woods. Well, what are we talking about with respect to the woods? There are a number of things that you could actually put there. And my colleagues have chosen employment as their marker for that. Well, with all due respect to my two erstwhile colleagues, employment is a little bit like Mater, right? You remember cars? Employment is sort of like driving the economy forward by looking through the rearview mirror, because it's a lagging indicator of economic activity everywhere you see it. And so what you're seeing happen inside of employment markets, as bad as it is, and I don't want to be, you know, the Marie Antoinette of forecasters here saying, well, just let them eat cake. That's not where we're at here. But if you're looking at employment as a gauge of where it is that the economy is going, you're looking at the wrong indicator. So I choose to actually say, okay, well, if we are going to make a case for being out of the woods, then you actually have to look at a leading indicator. Because if that is actually pointing north, you can conclusively say as an economist of whatever stripe that employment is going to follow that out. I think it's also important to understand the context that we've been over the last number of years. And the way that I choose to paint that is, in spite of the fact that we had something of a recession in 2001, it was very localized and it was related to a high-tech crash in the market. It wasn't the typical kind of recession that we had. So if you look at a longer continuum of growth over the last while, you can make a case for the fact that we had an expansion that extended from the early 1990s until when the crash happened in 2008. Well, if you have a normal length cycle, you always get a head of steam on the end of that, and that's what triggers a recession off. But if you have a super cycle, then you have an enormous period of excess. And that's what I believe that we had for 5 years ahead of the crash actually happening. There's a number of metrics that substantiate that. So if we've had a protracted journey here in terms of creating jobs again, you can't take that in isolation and say, woe is us. You have to look at the period of excess that we had. And it was an extraordinary excess that for the first time was exported everywhere because of globalization. If that's the context, then you would expect to see a long period of flat. And you would expect to not be saying, well, next year is the year that the recovery is going to occur. Well, let's change that to the next year and so forth. If you've had a 5-year head of steam on the whole economy, how on earth do you think that with a stimulus program that was the most extraordinary stimulus program that the world has ever seen, in 6 months after the crash, is that really going to lift the world economy up, or are you going to have a period of purge before things actually get back on their feet again? You can expect to have a long period of down in a context like that. If that's the case, though, and we're sort of 5 years out, then we might miss the boat. If we say, well, okay, well, now we're into this new normal thing, the economy is never going to come back, reality has sunk in, and that's where we're going to gauge our forecast. And I think we need to be instructed by the leading indicators of economic activity if we're going to get anything out of this. So Bob's freaking out because I've only gotten to my first slide and I'm almost out of time. So I'm going to go quick.
That's the new normal.
This is a housing market in the United States. This is housing starts. And this illustrates what I've just described to you. An enormous head of steam based on demographic requirements in the United States. The yellow line is a generally accepted demographic requirements number, and it just happens to cut right through the middle of the whole series, about 1.4 million units a year. They thought it was more than 1.4 million. Where's the pointer on this thing? They thought it was more than 1.4 million at this time. Everybody revised their demographic projection. And of course, when everything went into the can in the United States, everybody retooled their demographic projections again. Well, that's just what happens, folks. But demographics are one of the most easy things to forecast in the economy. It's almost as easy as saying next year we're all going to be 1 year older than we are this year. Okay? So this household formation number is very instructive to this housing market. So what is this telling us then? Housing is a leading indicator of economic activity. So when this crash happened, I don't think there was any self-respecting economist that thought it was going to crash by as much. That illustrates how much overhang there was in the economy, somewhat illustrated by my gray line here. That's the cumulative increase in excess housing in the United States. It was massive when the crash actually happened, and this is why it had to be as scathing as this. But look at, we've got these double-digit increases in this leading indicator over the last couple of years or so, and we are still 40 to 50% below the basic requirement in the economy. This leading indicator is in deficit, folks. And if you believe in leading indicators and if you believe in the dynamics of an economy, this is the kind of thing that is driving the economy forward and will result in much more aggressive employment in the next while. Well, this is the kind of thing I point to say, are we out of the woods or not? Not entirely out of the woods by this metric here, but it's going in the right direction. And the indicators inside of this market are showing me that there's tremendous pent-up demand. When you get pent-up demand inside of an economy, there are very few things that will lead it forward as dramatically as this. Okay, pent-up demand is not just in the housing sector, folks, it's in business investment as well. When you've got frenzied activity globally, you overinvest, because you have to keep your capacity up to the overconsumption that's happening all over the world. What happens to the average business then when the economy crashes? If you've been creating capacity to feed an overstuffed world, all of a sudden when the economy crashes, you have all kinds of spare capacity and you don't need to invest. You don't need to invest for a long time. And we've been in that investment hibernation mode for years, or at least the Americans have, and we have as well, and the rest of the world has done exactly the same thing. What happens when growth starts to pick up? Well, during the stimulus period of time, a lot of that unused capacity was soaked up, but then we went flatter. But look at what you see happening over time. We are just a hair under previous peak when all those excesses were in the economy. And we don't have an excessive economy right now. We have a deficit economy. If you look at the pace that orders are coming in right now, a la PMI indices in the United States, this is critical. We're on the verge, folks, of a wave of investment in the United States. Now, what's extraordinary about that is investment is usually a lagging indicator, just like employment. Now it's become very synchronized with the economy because of the capacity, utilization situation in the economy. So now we see we're on the threshold of investment as growth is picking up. These things are happening simultaneously. Now, why do I get concerned about that? Because investment is very volatile. We'll all agree up here that investment is a very volatile indicator. When it decides to take off, consumption is much more gentle, housing is a bit more volatile, business investment can just take off like a rocket. And if everybody everywhere is doing it all at the same time, then we're on the verge of a frenzied economy, and I worry about that. These dynamics suggest to me that this is the case. Okay, so these two indicators show that in the #1 economy of the world, which is accountable for 19% of global GDP, the engine of the world economy, is firing up. And I would say that this gives us a very strong sense that we are out of the woods. We are emerging from these woods, and this is a very good time to be alive and in business. When there's pent-up demand in the economy, it means you have to get out there and do stuff. I think one of the most remarkable accomplishments in the world economy and in the US economy has been the revival of confidence. Now they want to get out there for the first time in 5 years. They want to get out and be active in the economy. When you look at this chart here, you can see that blue zone is the recessionary zone of confidence. And in previous recessions, Americans are schizophrenic. You know, they're gloomy, they're not, they're gloomy, they're not, they're gloomy, they're not. And then they pop back out into the happy zone for good. And this happened in the last 2 recessions there. This time around, confidence crashed to depressionary levels and recovered to recessionary levels. 3 times they tried to bust out of this area unsuccessfully. And all on their own, without any policy stimulus, without any prod, this series came out of the recessionary zone, and look at the trajectory it's on right now. This is a new paradigm, folks. American consumers are telling us that we're out of the woods. And if they're leading the rest of the economy, we're good. I've run out of time. I'd love to talk about China and how Chinese trade is going to come back as a result of the American recovery, and how 8% growth is very achievable for next year, but maybe we will leave that for the debate time. Here are the reasons why we believe the recovery is real. I've gone through them. Trend growth is high. Leading indicators are pointing up. Pent-up demand is very strong. Sentiment is back for the first time in 5 years. No more austerity. We could go into that as well. Governments have done the austerity that has got them onto a sustainable track now. If you want to look for series that are out of the woods, look at the deficit to GDP ratios of some of the most stressed economies on the planet, and you will see that even they are starting to post balanced budgets. End of quantitative easing, we wouldn't be discussing it if it were not for growth. That's it.
Thank you, Peter. Very, very good. Well, there is a little bit of sunshine at the end of the hall.